All right, welcome to your Talk Tickers briefing. Today we are digging into Hess Midstream, ticker HESM, and their second quarter 2025 earnings. And let me tell you, this was a pivotal quarter for them. We're talking major strategic changes, powerful operational results, a lot to unpack. So let's get right into it.
So, first things first, Hess Midstream absolutely crushed it this quarter. And you know what? The market noticed, big time. The numbers really tell the whole story here. A clear outperformance on both revenue and profit. Let's start with the bottom line, profit. They reported GAAP earnings per share of 74 cents. Now, Wall Street was looking for 65 cents. So that's a 9-cent beat. That's not just a little bit better, that's a huge outperformance. It really screams that they've got their costs locked down and are running a tight ship.
And it wasn't just about profits. The top line, their revenue, was just as impressive. We're looking at over $414 million. That's more than $9 million above what analysts were predicting. And get this, it's a 13.3% jump from last year. That tells you demand for what they do is really, really strong.
So, how did the market react? Pretty much exactly how you'd expect. The stock popped 3.5% on earnings day. But here's the real story, the part you need to pay attention to. It wasn't just the price jump, it was the volume. Trading was more than double its daily average. When you see that kind of money moving, it tells you the big institutions are paying attention, and they like what they see. So you're probably wondering, how did they pull this off? Was it just a lucky quarter? Nope, not at all. This beat was all about execution. They were setting records out in the field, and for a midstream company like this, that's the absolute heart of the business.
Just look at these year-over-year growth numbers. I mean, they're firing on all cylinders. Throughput, that's the amount of product moving through their system, was up across the board. Gas processing, up 7%. Oil terminaling, up 9%. And water gathering, a massive 11% jump. This right here, this is the engine that drove that revenue beat we just talked about.
And hey, don't just take my word for it. The company's president and COO, John Gatling, said of himself on the call. He confirmed they delivered record operating performance, and he pointed directly to those volume increases. So management is making it crystal clear their success is coming from getting the job done in the field.
And just a quick primer in case you're a little newer to this space. When we say throughput, we're literally just talking about the total volume of oil, gas, and water flowing through their system. And for Hess Midstream, their business model is basically a toll road. The more stuff that passes through, the more money they make. More volume equals more revenue. It's really that simple.
Okay, so the numbers were fantastic. But honestly, that might not even be the biggest story this quarter. What's happening behind the scenes is a total game changer for Hess Midstream. The whole structure of the company is evolving, and it's making them financially stronger than ever. I mean, just look at this timeline. It was a whirlwind. First, in May, their longtime private equity partner, GIP, heads for the exit. Then, bam, July 18th, the monster Chevron-Hess deal officially closes. And just a few days after that, S&P gives them a massive vote of confidence by upgrading their debt to investment grade. Talk about a transformative couple of months.
And the new CEO, Jonathan Stein, is playing this perfectly. He's not talking about disruption or uncertainty. His message is all about partnership and excitement to work with Chevron. So the takeaway here is that they're framing this as a major upgrade, not a shakeup.
Now that S&P upgrade to BBB-, let's not gloss over that. That is a huge deal. Getting an investment-grade rating is like getting a gold star for your finances. It means it's cheaper for them to borrow money, it makes their balance sheet look way safer, and it basically gives them a ton more financial firepower. It's a real game changer.
Okay, so great quarter, stronger company. But what does it all mean for the future? For you, the investor. Let's dive into what management is saying about the road ahead, especially when it comes to guidance and giving cash back to shareholders.
All right, here's their updated forecast for the full year. You can see a few things here, but the number that really jumps out is the raised net income guidance. They kept their other targets the same, but they boosted their profit forecast. That's management telling you, hey, the strong results you just saw, we think we can keep that going for the rest of the year.
And they're not just sitting on that cash. They're being super aggressive about returning it to shareholders. Just in Q2, they bought back $200 million worth of their own equity. Most of that was to clean up their ownership structure, but they also spent $10 million buying back the public shares. That's a direct return of value.
And hold on, because they're just warming up. Management basically put a number on it. They said they have over $1.25 billion ready to go for shareholder returns between now and 2027. So this isn't some one-off buyback. This is a core part of their long-term strategy.
And it's not just a vague promise. They laid out a very clear three-part plan. First, grow the distribution, the dividend, by at least 5% a year. Second, keep buying back shares, about $100 million a quarter. And third, do all of this responsibly, keeping their debt low. It's a simple, powerful, and very investor-friendly roadmap.
All right, so let's shift gears and look forward. We've seen what happened, we know the plan, so what's next? What are the key things you should be watching between now and the next call? Let's talk catalysts and see what Wall Street is thinking.
So here's your watch list. Number 1, keep an eye on that distribution growth. Number 2, and this is a big one, watch the volumes in the back end. They have contracts that guarantee a minimum amount of business, right? Well, if drilling activity picks up and they get more than that minimum, that's pure profit upside. Then, of course, look for more buyback news. And the grand finale will be in January when we finally see their new long-term plan, now with Chevron in the mix.
So what do the pros on Wall Street think? Well, they're pretty constructive. You see, firms like JP Morgan, Wells Fargo, and Morgan Stanley, they've got price targets mostly in that $46 to $48 range. In plain English, that means they think the stock still has room to run, but in a steady, measured way.
Okay, so that's the street's view, but what about our take here at Talk Tickers? Let's put all the pieces together and make a call.
All right, here it is. Our call is outperform. We think this operational momentum is real, and we expect them to hit the high end of their own guidance. That should be enough to push the stock up towards those $46 to $48 price targets we just saw. But let's have a little fun. What's our outrageous idea? Well, management talked about getting more efficient in the Bakken. What if they get really good at it, faster than anyone expects? That could mean a boatload of extra cash, maybe a surprise special dividend, or a massive supersized buyback in early 2026. It's an aggressive thought, sure, but the seeds for it are right there in what they're saying.
And just a reminder, of course, this is not financial advice.